Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today talking about investing, the economy, all the things we talk about. Today we're talking about portfolio splits, gross domestic product, and also later on taking your calls. And with me is Chase. Chase.
Hey there. How we doing? Just want to, say good morning. As always, here to take your calls. Phone number here, 833-288-0973. Again, 833-288-0973. Gotta say, I was thrown off there. I started the show last week without you.
Was it last week or 2 weeks ago?
Last week.
Oh, yeah, because my bad.
And I'm like, I'm not starting. I gotta respond.
Well, and actually, you guys had a great game last night. You're the linebacker coach for Poway High, and so you might. I don't know if you guys want to celebrate, but you guys moved on to the.
We're moving on to playoffs.
Playoffs.
No, only undefeated team in San Diego. We had an easier schedule than some of the other teams in San Diego, but looking forward to whoever we get to play in the next round. So it's going to be a exciting couple weeks here for us.
You can play next week or
no? We get a bye week.
Bye week. Okay, so we'll find out in 2 weeks what happens. So,
yep.
Well, good. Well, quite the week here in the markets and so forth. But let's talk about some things here that we find important. Let's talk about the portfolio splits. Now, I've been investing money for clients for over 40 years, and it was not long into my career that I questioned rules of thumb, like the best portfolio is a 60-40 split of stocks and bonds. I always felt it was better to research deeply investments that were undervalued and would do well going forward. My fear has proven to come true over the years.
Especially now, as according to Bank of America, the 60-40 split portfolio is having its worst year. Wow. In 100 years, as the annualized change in its recent year-to-date value is down 34.4%. Year-to-date, we are down a little bit in our portfolio, but based on what we have, I still believe we can have a positive return come December 31st, 2022. With a 60-40 split, based on what we see going forward, I don't think that has a break even for at least 3 to 5 years. I still stand behind the statement that the rules of thumb when it comes to investing, they just simply don't work. And the problem, we've talked about this, is for bonds to recover here over the next couple of years, especially if you have longer dated bonds, it's going to take interest rates to go back down.
Right.
And I've said this before. I don't think the 10-year Treasury is going back down to 1% anytime soon. So it's going to be a very difficult thing for bond investors, and we haven't had bonds in the portfolio. We still don't have bonds in the portfolio, but the people that have kept them, they're starting to realize, I thought bonds were safe. They're not safe. The 60-40 split, year-to-date performance of it, I believe last time I checked, it was down about 20% year-to-date. That's not what people that go into bonds anticipate when they're investing and looking for safety.
And the other problem, too, Chase, is that back years ago, if you had a bond and it was paying 7 or 8% and it went down, you would get 7 to 8% to recoup your losses, and that'd be in 2 years, that'd be 14 to 16%. Well, now these bonds, some of them are paying 2 or 3%.
1%.
Well, I was trying to be generous.
Yeah, I'm being realistic here.
But I'll just use the 2 or 3%. So if you're down 10%, it would take you, just based on if everything's being equal, it would take you 5 years, 2% to get back just to break even. And that's what you have to realize, that the rates were so low in these bonds that you bought. And you're right. I don't see rates going back down. You're not going to get the recovery from the interest rate. It's going to be a terrible investment for the next 5 years.
Well, and then with bonds, what you could do, people say, no, but if I hold it to maturity, I don't lose on the price of it. Yeah, you're right. I guess you can collect 1% for another 9 years, and we're having inflation. We know that, right. And we don't think inflation's going, again, back down to 2%. So congratulations, you're earning your 1% interest for the next 9 years. That is going to be detrimental to your future net worth, your future economic purchasing power. I mean, it was a huge mistake to buy bonds. And you got to, again, understand how finance work, how there's that negative correlation with interest rates and people that bought bonds. It was a dangerous thing that you did for your financial future.
And that's why, again, I've been in the industry for over 40 years now, why I feel equities are the best. And the thing you got to realize, you're going to have volatility.
Yeah.
You're going to have losing quarters, losing years. But you will do far better in the right equities. And again, we talk about value investing, not gambling on some other crazy stock or cryptos or whatever. But buying true good companies, you will far outperform anything else if you understand what you're doing. That's how we have grown the firm to a $500 million firm, by actually doing that.
Yeah, and the thing is that's interesting is Harrison and I talked last week on the show was we might have bonds in the portfolio next year. I mean, It could happen. And people are like, oh, they're just equity guys. No, we buy real estate. We buy bonds. Mm-hmm. Obviously, we buy equities.
Right.
We bought gold in the past. We'll buy whatever we see that's going to be a good fit in the portfolio. But, I'm not just going to buy bonds to satisfy somebody that has a low risk tolerance and wants to be conservative in their investments because it's going to hurt them.
Yeah.
And I'm not going to tell people, it's a good idea. It was a terrible idea.
And I know that Bank of America did this study here. I would love to have someone do a study on how those target date funds are doing.
Oh, yeah.
Because we've hated target date funds because, again, as you get older, we got to put more in bonds to be safe. I imagine some of those that are 5 year from, this is 2020. So 2027 target date funds, they're probably hemorrhaging right now.
Or they still have target date funds that are like 2020. So they can still occur in the past, and then they just become more and more heavily weighted into bonds after you retire.
Yeah. Yeah, and we've talked before on that. We've done posts on it and so forth about the fees on those target date funds. Now you've got the decline in the bonds. Never liked them, never will like them.
The net redemptions.
Net redemptions. Yeah, that's true as well. So, and I just hate when I see somebody, and we just saw this the other day, like they had like 20 options. Of which like 15 were all target date funds.
Yeah.
That's terrible. Well, let's move on to the gross domestic product because the Q3 GDP produced the first positive growth of the year as it increased at an annualized rate of 2.6%. The consumer continues to remain strong enough to produce growth as the consumption category grew 1.4% in the quarter. This was entirely due to the service economy, which was up 2.8% compared to consumption of goods, which fell by 1.2% in the quarter. Gross private domestic investment continued to struggle as it fell 8.5% in the quarter. This was largely attributable to the decline in residential investment, which fell 26.4%.
In that category, a couple of highlights there. Equipment and intellectual property products were actually positives. They grew 10.8% and 6.9% respectively. I think that's actually a big positive that businesses are still investing in equipment. That, I think, is a sign that, we might have a recession, but it's not going to be a terrible recession. Right. If businesses are still investing, I still see that as positive. Another thing that was a drag on the GDP report was the change in private inventories continued to weigh on the report as it subtracted 0.7% from the headline number. And with the heavy inventories at retailers, I believe this could remain subdued for the next quarter as well. The major highlight came from the trade component, which added 2.77% to the headline number. So without that, the GDP report would have actually been negative. This came as exports climbed at an annualized rate of 14.4%, and imports fell at an annualized rate of 6.9%. With the likelihood of the strong dollar remaining in place through the remainder of the year, I'm skeptical that we will see another major benefit to trade as we close out the year. The final component, which is government, was also a benefit as it added 0.42% to the headline number. Overall, I'd say the GDP report was good, especially considering a lot of the fear from people at this time.
Yeah, and that was quite the report. I saw somebody like, it's because of government spending. Government spending did not show up at all. It was because of the strong dollar and the decline of imports coming in. Mm-hmm. And partly you and I talked during the week, and this is what we do on Saturday morning. We kind of share our thoughts during the week that we have, but we talked about the pullback in China. So that could have been a factor as well. So if China reopens and starts doing a lot more production, will that change in the next quarter?
And I was reading the other day that, President Xi now with his kind of new party that's in place, and I don't know the exact structure of the Chinese government, what they're called and so forth, but they said essentially they're doubling down on the zero COVID policy. And that again, could weigh on trade for us, because if we're not bringing in as many imports from China as we were in the past, well, that actually, again, is a benefit to GDP because we're not importing as much. And then also, too, if China is not exporting their goods around the country, well, we may be having to pick up slack. Also, too, we talk a lot about energy. Unfortunately, this report didn't break out necessarily what our exports were, but I'm very curious what our energy exports are, because we know Europe now is not able to get their energy from Russia as they were kind of at the beginning of the year. So how much is that helping with our trade as we're sending more energy to our European allies?
Yeah, and I don't have the number on that, but I did see that came up in the Wall Street Journal that, yes, that was one of the factors of us shipping more energy to Europe to help out their situation. And I did also see, too, that Europe is abundant in natural gas now. I guess we've done a great job with that, which helps the whole world situation, because, oh, my gosh, you're going to freeze over in Europe. And they said in the Wall Street Journal that if they have a really cold winter, it's going to be a problem. Yeah. But a normal winter, they have enough supply to not have a situation. And we have seen natural gas. I mean, at one point, natural gas was like $10 a BTU, British thermal unit. And now I think I saw it at 5 and change. Yeah. So that's helped a lot. So we fixed that situation. But also, too, I was going to say on the GDP report, it could change next quarter because there was a benefit from the strong dollar, which I don't think the dollar will get stronger. I don't think it'll get weaker. But and also, too, the United States, we are not doing as much with China because they're just shut down. But we're now finding, well, let's work with Thailand. Let's work with Vietnam. Different ones. So, which I prefer, because I've written this many times that I am very afraid of China. I even said this on the Dr. Phil show, Ron, that I'm concerned about China because now Xi is a dictator. He can do what he wants to do. And he has said that, yes, we are going to be a global world power. And if we keep giving them money, that their arsenal, we did this, I don't think we talked about it today, but I'll just throw it out there. They now have 2 million men in their army, people, I guess now, versus our 1.4 million, and they now have more ships than we have. They are moving forward to become a world power, and we keep buying their stuff. We just give them the money to do that. So I'm glad to see us changing over to Vietnam, Thailand, these other places, diversify the goods, so to speak.
Yeah, and I kind of back to GDP as well. I'm curious to see what's going to happen here Q4, because, again, a lot of the negativity in this report came from, the residential investment here. And it was so negative that can it be that negative again next quarter? So it was a huge weight to the downside. So I don't think trade is going to weigh as much to the upside as it did this past quarter. But I also don't think that the residential investment is going to be such a negative weight in the next quarter as well. I think that we still could have a positive report. I mean, the consumer is still in a fine spot. We're not, again, booming where the consumption category is going to grow at 5%, let's say, on GDP, but I still think that they can remain positive. And I think Q4 GDP still should be positive as we close out the year.
And also, too, let's not forget about, we are basically a service-based economy. Yeah. That was up, 2.8%. So services could improve even more, which could help the GDP. So don't forget that's part of it that is changing. Well, let's move on to oil companies, because I'm sure you have heard all the bad news about all the big profits that oil companies are making. But what you don't hear is how much they spend and what they are doing for a green future. Both Exxon and Chevron are building offshore wind farms, which will supply millions, that's right, millions of homes on the East Coast with electricity.
They're also preparing production of hundreds of millions of gallons of fuel, which will come from plants, garbage, and even kitchen grease. Oil giant BP just spent $4.1 billion acquiring a company that replaces fossil fuel gas from wells with naturally occurring biogas from landfills. The oil companies know that the times are changing, and while they are accused of paying out big dollars to the shareholders, they are also investing their profits for a greener future as well. I mean, we've talked about this where these oil companies aren't just standing by and being like, oh, well, times are changing. Yep, we're just going to focus on the past. I mean, we have a refiner in our portfolio that does a lot in the biodiesel industry, and the renewable diesel industry is another term for it, that I think that could be a huge help to society. They even say it's more green than electric cars.
Yeah. Yeah, and that's, and somebody says, "Oh, the oil companies are done." They are not done. They are redeveloping themselves. And also, too, I read recently too that the peak on oil probably looking at 2025 to 2030. So it's not like, oh, it's going to happen tomorrow. You got some time on that. And think of all the billions of dollars oil companies are going to have to put in R&D to come out with things like the biodiesel, like the wind farms and all the stuff that they're doing. So, and they're still not very pricey. When you look at oil companies, they're still trading, I think, around 10 times earnings.
I will say I am a little skeptical of that multiple, just because they have such high profits right now from what has occurred that I think next year will be fine, but maybe 2 years from now, 3 years from now, those profits will come back down as I think the price of oil, the price of gasoline, diesel will normalize. So I think it is a little bit misleading in terms of the exact valuation that you're getting on that company. Mm-hmm. I'm not going to say they're extremely pricey by any means, but I don't think they're a great value at these prices. So I would say just be careful looking at that PE multiple, because you have to, again, look at the cyclicality of the energy sector. But I was going to say as well, is it's kind of funny you call them oil companies. I think we should just call them energy companies.
Right, energy companies, yeah. And that's one thing that I look at going forward, is that they are going to be changing. They are going to be producing more oil, but also using that money to produce new products and R&D. So, I don't want to say like, oh, yeah, they're great value, you got to buy these. They were a great value 2 years ago, and I'm glad we bought, the oil company that time frame. But I wish we bought two.
Yeah. I'm just saying, look at it very, very closely. Right. I think there's some energy companies out there that are still good buys at these prices, but you just have to kind of look at it with a little bit of skepticism of, how skeptical. Like, look at the past 10, 15 years. You can look that up on different platforms to see how much their earnings kind of change over time and the big ups and downs, because all of a sudden you can go from having a multiple on the earnings of, let's say, 10 times, but then earnings fall off and now you're trading at 20 times. Right. So just be very careful.
Be careful, exactly. And that's the benefit of why we want to run a concentrated portfolio, which a lot of people, you got to have 50, 100 positions. No. Concentrated portfolio is one of the secrets to success of having a very good return on portfolio. Let's open the phone lines, 833-288-0973. That'll get you through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Again, 833-288-0973. Chase, let's talk about the product shortages, because things have really changed about 180 degrees from less than a year ago when there were shortages of products available. Inventories are now so large on some products that warehouses are bursting at the seams. The vacancy rate in warehouses in the third quarter of 2020 was 5%. That has now declined to 3.2%.
And currently, businesses are paying more per square foot in warehouses. Last year in the third quarter, it was $7.13 per square foot. The average has now climbed to $8.70 per square foot. What does that mean to you as a consumer? Retailers want to get rid of these items costing them money just sitting in the warehouses. Consumers could see some great sales coming up in the future. You just got to keep your eyes open. And it may not be necessarily what you're exactly looking for. Right. But if you have an open mind of what you want to buy right now, I guarantee you can find some great deals. Because, as I said, retailers want to not pay that $8.70 per square foot. They want to get that out of the warehouse and get rid of it. And sometimes, they sell them to the Marshalls, the Ross stores, to kind of cleanse themselves of that older inventory so they can get the new inventory in. And right now we had that huge mismatch after all the shipping issues that we had over the past couple years.
Yeah, and actually, it's going to be on products like apparel, shoes. Yeah. That's where you're going to find the great deals. But again, you're going to get some great deals on that. Unfortunately, price of chicken probably will not be one that you're going to get a good deal.
I do need some new shoes, so I'm kind of looking out right now. So.
Are you hitting for Christmas presents? Well, let's talk about, we got some exciting news coming up on Thursday, November 17th at 6 p.m. We have not had time to do this. We found the time to do it. I'm talking about a workshop that we've done in the past. And if you never attended the workshop, people just love these. I've done thousands of these now over the last probably 25 years. And if you're unhappy right now with the returns in your portfolio, you don't know why, this workshop is for you. Many people right now are afraid to invest these days because, I'm afraid it's going to go down. down more. I'm afraid this is going to happen. We're going to go over why that is. And maybe, just maybe, you're so confused you don't know what to do. That's why we talk about using fundamental analysis, which keeps you on track. We show you everything we do, how I built that $500 million portfolio for our clients. But what you got to do, you got to sign up. You got to go to our website, smartinvesting2000.com. That's smartinvesting2000.com. It is a free workshop. We don't charge for it, but you got to show up. It's going to be, again, Thursday, November 17th at 6 o'clock in Scripps Ranch. Again, go to our website, smartinvesting2000.com. And, Chase, we love doing these because you get to actually talk to our listeners, talk to other people, see what they've done. Sometimes it's like, oh, that was not very good, but I like helping people out. And again, free.
Yeah, we're looking forward to it. As you say, we haven't done one of these in a couple months, so it's always nice to kind of resurface
5 months, I think.
Yeah, and it's the first one in our new office, so we're super excited to kind of have people come see the new space, and it'll be a good time.
Yep. Again, that's smartinvesting2000.com, and that is Thursday, November 17th, 6 o'clock in Scripps Ranch. All right, the phone numbers again are 833-288-0973. That's 833-288-0973. Before I go to the calls, I forgot to promote the newsletter, because the newsletter, has a lot more information in it. We have in there, we talk about petroleum reserves. We talk about Tesla stock. Remember Kathy Wood's ARC Innovation ETF. We talk about that, the job market. So if you want to get more information like we talk about here on the show, go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And right there in the middle, about the top of the page, you'll see newsletter. Click on that, and you can get that free newsletter. Every Friday it goes out about, I think, 5 o'clock, right?
Yeah, sometime around. I know it's a little bit after office hours.
Yeah, but you can read all weekend. And actually, and you get a lot of information probably you can read in within 5 minutes. And you put a lot of information that I think is helpful for you. So get a newsletter at our website, smartinvesting2000.com. All right, let's go to San Diego and speak with Wayne. Wayne, you're in the Smart Investor over at Chase. How can we help you?
Good morning, gentlemen. I'm looking at stock called BJ Wholesales. It's similar to Costco, but they're on the East Coast and they're moving to the Midwest. I'd like you to review the numbers. The symbol is BJ. It's moved up to about 10% in the last month, though.
Okay. And so you haven't bought it yet? You're just kind of looking at it?
No, because it keeps going up.
Yeah. and I like the concept, because when I'm kind of thinking like you, and I've seen this company, could this be Costco at, we'll call it just half price? I do have some friends back east, and they're not as excited about BJ's, or people are excited here about Costco. That was the only thing. I was, yeah, it's okay. So, but let's look at the numbers here for you. Again, the company is BJ Wholesales Club. Symbol is BJ. The discount store industry, 4.7% float. That's not bad at all. Institutional ownership, 101%. Ooh, that means there's probably some short on something's. I always hate when I see that. There's something
from the shorts, yeah.
Yeah, from the shorts, yeah. So, but that's a big institutional ownership. We do see that they reported last period was 7/31/22. Next report date 11/17. Look at the PE ratio, 21.8. That is below that industry of 28.5. Price to sales looks good, 0.6 versus 0.9. Price to book value, 12.3 versus 6.4. That's not good. These are valuation ratios. You want them lower than the industry. And then we do see price to cash flow. It does look good, 14.9 versus 20.9. And a good PEG ratio of 3.5, about half the industry at 6.4. Now, we do see over the last year, they grew the earnings by 20.3%, about double the industry at 9%. Sales over the last year up 15.9, also far better than the industry at 4.5. We do see a 5-year earning per share growth of 6.5%, not as good as the industry at 9.7. They do not pay a dividend. We do see on the balance sheet, current ratio 0.7 versus 1.0. Little bit low. I'd be watching that. You don't want that to go any lower than that. Debt to equity not looking good at all. 3.9 versus 0.9. They could have a lot of debt on the balance sheet, which could cause them growth problems going forward. I know you mentioned about them expanding into the Midwest, but they got to be careful about over leveraging themselves. We do see a net profit margin 2.7 versus 3. Return on equity very good, 57.1 versus 20.1, and return on invested capital 12.4. versus 14.8. So kind of some good things here. Chase, what do you got going forward?
There's a current price here for BJ's Wholesale Club, $77.81. Close to its 52-week high, $79.69. And the low here, $51.45. It is a decent-sized company with a market cap of $10.5 billion. It is kind of disappointing. I know people have that affinity to Costco, and they're like, I love Costco.
Right.
That's kind of upsetting. It would concern me to buy the stock if people that go there are like, it's okay.
Yeah.
That's a big difference compared to.
and Wayne, I have to interrupt you there and say that you said you talked to some friends as well. I mean, the Beckys, how do they feel about BJ's? Any comments on that?
Well, they like it, but they prefer Costco.
Oh,
yeah. Okay.
I have family in New England, so they go back and forth.
Okay.
All right. So looking at the earnings, I mean, the company is profitable, so that's a good sign. They're still making money. But they go out to January 2024. The estimated earnings per share, $3.90, would give us a target sell price here, $64.74. Unfortunately, that's below the current level here for BJ's Wholesale Club. So it is actually still a little pricey, even though it's not as pricey as Costco.
Yeah, and those earnings have come up from $3.67 90 days ago, but still they need to come up a lot more, or the stock needs to go down for them to buy.
I am curious, too, because one thing that people really like about Costco from an investment standpoint is the reoccurring revenue on their memberships. How sound is the membership program at BJ's Wholesale Club? That'd be something that I would really want to understand. Again, it's pricey, but if I was looking at buying this business, if it did fall, how sound is that membership program?
Yeah, and I think you said the target sell price is what again, Chase? I always do that to you.
I know.
80 something?
No, it's 60.
Oh, wait, so it's below the current price.
Yeah, it's below the current price.
You know what? I'm kind of disappointed.
64.74.
So okay, so I'm disappointed with that, Wayne. I was hoping to get some value there. I was going to say do some research on it, but I just don't think it's worth it because it's just too expensive.
Yeah.
So I'd have to go down to probably like 40 for us to get excited about it.
Mm-hmm.
So
I'm just worried about the recession that's going to come after the beginning of the year. So I just think that maybe the consumer will look for discounts.
Yep, that could be, but I think they're going to go to Costco, not BJ's.
I guess so, by those numbers. I appreciate it, guys.
Wayne, thanks for calling. Have a good one.
Bye.
Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973.
And by the way, that was not an endorsement to buy Costco stock. Costco stock is still extremely expensive, but I still think people will go shop at Costco if we do have a recession here.
Yeah, I think you're right. Yeah. And Costco, a great company, but it's just, again, it's just too expensive, and it doesn't make sense to buy it. But I do like going there. I don't go there as much as I used to, though. I don't know why.
I don't either, actually.
Yeah. I don't know if the excitement's gone. I don't know.
I hate to say it. I've been using Amazon a lot more.
Really?
Yeah.
Well, actually, Amazon's way down. Maybe we'll buy Amazon.
Not quite yet. It's still expensive.
Okay.
I mean, I actually thinking about becoming a Prime member. I haven't made that.
Really?
Yeah, changing.
Yeah. Well, I mean, you got to go where you get the good buys as a consumer.
It's just easy.
So, all right, let's head up to Temecula and speak with John. John, you're in the Smart Invest Show, Brent Chase. How can we help you?
Yeah, good morning, Brent and Chase. Thanks for taking the call. I'm looking at a REIT, and I've been looking at some apartment REITs. Trying to get maybe in a residential aspect of it, and I've been looking at BRT, but it's pretty small. It's only about $350 million market cap, and so I've kind of set my sights on IRT, Independent Realty Trust, and wondering what your thoughts are on that REIT. I like where they are, buying property, and it's all across the Sun Belt, so I think it might be an interesting play.
And actually, you bring up it's all across the Sun Belt. That's one thing you want to be really cautious of where they're putting their apartments. And I think you said this is an apartment REIT, correct?
That's right.
Yeah.
Yep.
The other thing that I'm seeing, and I'm just talking about here in San Diego. I know you're in Temecula, but I am seeing tons and tons of apartments going up. Now, I go down 15 all the time. There's a big build there, but it's actually a senior living area. It's in Carmel Mountain Ranch.
Oh, yeah.
Yeah, and that's going to be senior. But there's still apartments being built all over the place. So that's one thing I worry about. Will the supply a year or two down the road really exceed the demand? But let's look at the numbers here to see if it's worthwhile getting Independence Realty Trust, IRT is their symbol. Only 2.9% float there on the short side. Institutional ownership 84%. PE ratio 26.6 versus 21.2. Price to sales 6.1 versus 7.8. Price to tangible book value 4.1 versus 4.4. That's a big positive there for the company or for the REIT. Price of cash flow 27.6 versus 18.6, and PEG ratio not very good, 44.7. But the industry is at 278, and that could be because, again, with the REITs, we actually want to look at FFO, and I think, Chase, I think you covered that a little bit. Yeah, so we do look at the earnings. They were up 131% over the past year, well ahead of the industry at 14%. Sales up 94.7%, also well above the industry at 8.3. We do see a 5-year growth rate of 5% versus 0.5% for the industry. A little bit disappointing, the dividend, 3.3%, but the industry is at 3.2. I know the REITs that we have, they're paying a much higher yield than that, but that's what you get. They use 75% of their earnings to pay that out. We do see that on the balance sheet, current ratio 0.1 versus 2.9, but again, remember this is a REIT. Debt to equity looking pretty good, 0.7 versus 1.0. Net profit margin 24.3, very good, but the industry is at 39.1, and return on equity not very good, 3 versus 7.9. Chase?
Yeah, so current price here for, again, Independence Realty Trust, ticker symbol IRT, $16.75. 52-week high here, $28.42, and the low, $15.04. Now, if we look at the, again, funds from operation, FFO for December 2023, I see it's estimated to be $1.17. Means they're trading at a PE right now about 14.26, but that would give us a target sell price here of $19.42. So it is above the current level here. Let's see what that would be in terms of a growth rate. It's about 16%. So I would like to see it pull back a little bit more just from a strict value perspective. Again, we like a 30% margin of safety here. As Brent kind of echoed that, I do want to be cautious on the fact that how many apartments are being built, because we get a very small subset here in San Diego. What's going on? And I saw there in like Raleigh, North Carolina, Louisville, Kentucky. What does those markets kind of look like if you are looking at buying this business?
And I'm disappointed too that because their high is 28.42 and 16.75, so they pulled down a lot on their price, and you still only get a 3.3% dividend.
That's strange for a REIT.
Yeah,
I'd like to see, especially at the REIT, a nicer yield, and I'd like to see, especially in this type of environment, I'd love to see on the REITs somewhere in the 5-6% range. For the real estate. Yeah, and
I'd want to find REITs that hold not apartments, but something that's going to be better down the road. And we have looked at office REITs. We still haven't said, still don't think that's a good place yet. But we do like medical REITs. We liked gambling REITs.
I like warehouses. Warehouses are just expensive.
Yeah, warehouses. Yeah. So I got to be honest with you here, John. I just don't think I like this one because of what they do. And the numbers just don't pan out for you. All righty?
Yeah, thanks. Yeah, I thought to your point, I thought the yield was a little low, which is why I was headed maybe towards BRT apartments. And but at $400 million, I just thought that might be a little too small a cap to delve into. But they've had a return of 15% over the last 15, 20 years, so hard to bypass.
And we can't actually buy one that small because we would actually move the market when we buy it. But you as an individual investor, you could, but you got to do a lot of research because there's probably not a lot of analysts on it. You have to really understand what you're doing because some small caps become large caps, but you got to, again, check those fundamentals to make sure you know what you're doing on that one.
And REITs have also been, like bonds were before this year, REITs were a big benefactor of falling interest rates that really, I think, elevated their returns. So that past performance is not, I think, going to be as strong going forward in a higher rate environment. I don't want to say all REITs are going to struggle, but I think you just got to be more cautious of the REITs that you're buying because it was such a easy environment for real estate investors with a low cost of capital.
Yeah. All right, John.
Yeah, 100%. That's my concern going forward too on REITs is where we will be with that. So yeah, thanks guys, appreciate it.
All right, you're welcome. Have a good one. Bye-bye. Bye. All right, that opens the phone line 833-288-0973. Again, that's 833-288-0973. And before the next call, I do want to mention again about the workshop coming up Thursday, November 17th at 6 o'clock in Scripps Ranch. Learn why we are value investors. We'll talk about why we love value, why value has done so well over many years, the key to successful long-term investing, And our investment philosophy, exactly how we invest and manage our money at Wilson Asset Management. We'll show you that. We'll talk about it. We'll answer your questions. Again, it's a free workshop, November 17th. That's a Thursday at 6 p.m. in Scripps Ranch. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Look forward to seeing you again on Thursday, November 17th in Scripps Ranch. All right, let's go down to Imperial Beach and speak with Tim. Tim, you're on the Smart Investor with Brent Chase. How can we help you?
Hey, good morning, guys. I enjoy your show.
Well, thank you.
Kind of a general question here. With the inflation we're all experiencing right now and the recession that they're saying is coming, whether it be a soft landing or a hard landing, what are your thoughts on some of the discount stores like 99-cent store and the discount tree store and the other type of public stores like that?
I'd like to look at one. Can you think of a name of one, Chase, or the symbol of one?
A 99-cent store is not publicly traded. I know there's Five Below, which I know is just expensive. Big Lots was another one, but Big Lots I just don't think is that popular anymore.
Yeah.
There's obviously Dollar Tree, Dollar General. Both of those are pretty pricey. I know I just kind of pulled up their forward earnings.
Yeah, and that's what I was going to do. Do you have the symbol for Dollar Tree? Or
Dollar General, let's see. I think Dollar Tree was actually the one that was an interesting buy perhaps at the beginning of the year, but I think they've kind of recovered in price. So let's look at Dollar Tree perhaps. It's DLTR.
DLTR. Yeah, because I want to kind of look at that, because then I can give a little more information here, Tim, on what they actually look like here. Because I get the concept, because, things are slowing down. And my feeling is I don't believe we're going to have a major recession. I think it'll be a mild recession. As long as that job market stays strong, I don't think you're really going to feel it that much. But it's one thing I see the direction you're going.
Yeah, and I unfortunately, too, I just kind of want to throw in that plug again for like TJ Maxx and Ross Stores. All those, too, when I look at them, they're just expensive still.
Yep. So we'll take a look at the Dollar Tree here as an example. Doesn't mean it's the one that you want to go with. Their symbol is DLTR. They are in the discount stores category. Only 3.3% float, 98% institutional ownership. 22.8 is the PE ratio, but that is below the industry at 28.5, and that's for the average for the discount stores. Price of sales 1.3 versus 0.9. Price to tangible book value 10.7. That's better than the industry at 22.2. Price of cash flow, though, very expensive, 29.4 versus 20.9. They do have a good PEG ratio, 1.1 versus 6.4. Now, their earnings were up for Dollar Tree 9.5% over the past year, better than the industry at 9%. Sales only up 5.4 versus 4.4 for the industry. The growth rate looks very good, 20.8 versus 9.7. That's a nice 5-year growth rate. They do not pay a dividend, unfortunately. Look at the balance sheet. Current ratio 1.5 versus 1. Debt to equity 1.2 versus 0.9. I'm okay with that as long as they don't increase their debt anymore. Net profit margin very good, 5.8 versus 3. Return on equity 18.7 versus 20.1. So, Jason, what do you got going forward on this company? I see their share price is not really on sale.
Yeah, the current price here, $158.55. 52-week high, $177.19, and the low, $103.45. See, year-to-date, the stock's up 12.8%. And this guy, what I'm talking about, I remember it was sometime around last year, there was this big spread between Dollar Tree's valuations and Dollar General's valuation. I kind of pulled them up. Dollar Tree's up 50% over last year, while Dollar General's up about 18%. So it looks like Dollar Tree was able to kind of resolve perhaps some of the issues they were having, as their one-year performance has been quite strong. Now, this is kind of where the unfortunate part ensues. I go out to January 2024. I see estimated earnings per share here of $8.26. So using that in our 16.6 multiple, we get a target sell price of $137.12. So, I mean, I'd love to buy something like this, but I think people have started to pile into these names with concerns of recession. So I think a lot of that has already been pulled forward, and it's too expensive. Last year, I remember looking, I'm like, oh, actually, you could get this on sale.
Right.
And now that opportunity, unfortunately, has passed.
And actually, you know, we're all thinking the same thing, like, okay, this is a great time because of recession, people buy more. That's not what the mean of 26 analysts are looking at. 90 days ago, the estimate earnings were $9.37. So they're looking at them earning less, not more. Maybe people, even during a recession, they won't be going there as much. So
Or the cost of labor could be a huge
that's true.
huge weight on them. The cost of maybe
Transportation.
inventory.
Yeah.
They should be getting inventory for cheaper, but transportation, you're right.
Yeah.
So, their costs could be climbing, maybe not their sales, perhaps.
Yeah. So just based on that estimate, Tim, I'm going to say no, but Chase, you did bring up, what was it, Dollar General?
Dollar General's not a buy either.
Oh, okay.
Yeah, it's because I've looked at all of them. They're all just kind of trading around that 20 times future earnings range, which again we know the long-term average is 16.6.
Yeah, well, thanks, guys. You confirmed what I thought. I assumed that ship had sailed about a year ago, and it appears that it has. But anyways, we'll see what happens. And I agree with you. It's going to be a negligible recession, and then we can move on from this and get back to business.
Yeah. And Tim, one thing that we look at is not where things will be in 6 months, but what's going to be hot 2 to 3 years from now. That's why again we kind of look at down the road, because it is too late now to think about the recession because it's here, everybody knows about it. But what is on sale now that in 2 to 3 years will be hot? That's what we look at. Just to give you a little tip there. All righty?
So in that regard, let me just throw something else out at you. What is your take on lithium mining areas and electrical batteries in that area? It's really competitive. You're getting the big Fords and everybody else, trying to catch up to Tesla, but taking it off the battery manufacturing, going into the mining. What are your thoughts on that?
Big problem with that is that China does a lot of that, which is a problem. And the ones that I've looked at, they're still not making profits. And that's one thing, too. We want a company that's still profitable, that's on sale, that will do well 2 to 3 years down the road. Now, what you're looking at is that, the batteries, that's something like a growth industry. Many times you don't have profits. So our philosophy is they've got to be having profits now and not a lot of debt. Other problem too, a lot of those companies have a lot of debt.
Yeah, give you an example here, Tim, is what we're looking at is stuff that's profitable, but people hate right now. Like semiconductors. People hate semiconductors right now.
That's our secret, Chase.
I know. I'm not going to give them, because there are some that are still too expensive, but that's kind of what we want to find is things that have been tried and true over time, but that people just hate right now. That's what we want to find.
Yeah. Okay, Tim?
Right. Excellent, guys. Thanks so much.
All right, have a good one. Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And it's 8:42, so it's time to talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Well, good. Today we're talking about how spouses' age difference affects Social Security. Wow, that's a tough one to touch, is that age thing. Be careful here, but I'm going to let you turn the mic over to you.
So with Social Security, you can collect any time between 62 and 70. You don't have to wait till your birthday or your full retirement age or anything. Any month between 62 and 70, and every month you wait, it gets a little bit larger. I'm generally in favor of having people collect earlier as opposed to later, assuming that you're retired, because if you wait to collect, you still need to get that income from somewhere, and usually that comes from depleting your other assets, which can cause you to deplete your assets too quickly, or the withdrawals from those assets might be taxed higher than Social Security is. And also, when you compute the net present value of different Social Security options, usually it points to collecting earlier as opposed to later. But the point that I want to talk about the age difference is, in many cases, when you have an age gap between two spouses, I would say 10 years or more, then it can look a little bit different. So when you have two spouses on Social Security, when the first passes, the survivor will keep the higher of the two. So they lose the lower of the two. And because of this fact, it can make sense for an older, higher earning spouse to collect at 70 to get the highest amount, and then have the younger, lower earning spouse collect at 62. So by waiting until 70, the older spouse ensures that not only will they receive the larger amount for their lifetime, but then also their spouse will get that for their lifetime as well, which could be, a substantially longer period of time. So it's not always the case to look at that, but, I've recommended people look at age 62, 67, 70, any time in between there. It depends on the situation. But this is an example of, it might make sense to in some cases wait till 70 if you're the older spouse and there is a large age gap.
You know, and and this is like a great tip, and this is one of the many tips that you look at for your clients. And I know we got an email from somebody that I think they shopped around different financial planners and came back to you, so they're like, Harrison does better than anybody else. So, and this is why these little things you look at is little details like the age of the spouses and so forth, and the age of the people, how to do things, as opposed like just building a financial plan off of some program or something.
Yeah, I mean, I use a program to do it, but that's not the point. I use the programs almost for presentation purposes, but the actual recommendation, you know, you have to look at income sources, assets, how that changes throughout time, spending needs, taxes, all of these things. And by understanding that and how those all evolve over time, that's what how we choose to make the right decisions with Social Security and with everything else.
Yeah, because everybody uses a program. Obviously, you'd be kind of silly to do it on a pencil and paper, but it's important to understand the details of what you're putting in and what you're getting out from that information, which a lot of financial planners don't. They're just so robotic about it, just depending so much on the program as opposed to really understanding tips like you have and these different things that you think of on how to do better, because you got to think about that. You do that with, you know, the Social Security, with the IRAs, with their pension, with their real estate. I mean, all these different things you do. I mean, it's just great. I just want to point that out. I mean, that's why you're so busy all the time, because everybody wants to talk to Harrison Johnson to do their financial plan. So we appreciate you being with us, and another great tip from you there.
All right. Well, thanks for the time, guys, and we'll see you on Monday.
All right. Sounds good. Have a good one. Bye-bye.
All right. You too. Bye-bye.
All right. Again, that's Harrison Johnson. He is our financial planner. He's a CFP. He's on a salary. He does not charge commissions or get paid off products. He, again, is on a salary, so it's an unbiased opinion. It is a fee-based financial plan. You want to sit down, talk to Harrison, give him a call at the office at 858-546-4306. That's 858-546-4306. Or you can find him through the website, smartinvesting2000.com. That's smartinvesting2000.com. All righty. Phone numbers 833-288-0973. Again, that's 833-288-0973. Let's go to San Diego and speak with Jeff. Jeff, you're on the Smart Invest Show. Brent Chase. How can we help you?
Good morning, guys.
Good morning.
What can you tell me about Skechers? I know it's cheaper than Nike.
Yes. I don't wear their shoes.
I believe they're the second biggest shoemaker next to Nike.
You know, and I'm just thinking, I don't know why I don't have a pair of the shoes. Chase, have you ever tried them?
No.
Jeff, do you have a pair, Jeff?
No, I wear Reebok.
Okay. Well, I'm excited about this because I know it's a popular shoe. I know I've looked at buying this company before. So I'm excited to look at this, but I'm just thinking, I don't know anybody that I can think of off the top of my head that has a pair of Skechers.
And honestly, I've seen the commercials. Some of them look pretty cool.
Yeah.
It's not like they're not cool, you know?
Yeah, they're not like those Crocs.
Yeah.
Well, let's look at the numbers here for you, Jeff, and we'll go from there. Again, the company is Skechers. Symbol is SKX. They're in the footwear and accessories industry. Only 5% float on the short side. 98% institutional ownership. We do see PE ratio. Wow, very good. 7.5 versus 20.9.
Yeah, that's what attracted me to
Yeah, price to sales looks good too. 0.7 versus 1.8. Price to book value 1.5. Tangible book value versus 30 for the industry. Price to cash flow does not look good though. 105.3 versus 25. You'd have to look at the cash flow statement to find out why that looks so strange. And a no PEG ratio, unfortunately. Now, earnings over the last year are up 81.3%. The industry was down 6.1%. Sales, they grew by 15.3%, above the industry at 3.8%. We do see a 5-year growth rate. Wow, I've never seen this number so high. I'm kind of skeptical of it. It's 1,462.5%, the 5-year growth, versus 41.5%. So I would be skeptical of that 1,400% growth. Unfortunately, do not pay a dividend. Look at the balance sheet. Current ratio 2.3 versus 2.4. Debt to equity 0.5 versus 0.9, so we got a good balance sheet. Net profit margin 10.4 versus 9.3. Return on equity is 21. not quite as good as the industry at 35.1, but I'm liking what I'm seeing. What do you got going forward, Chase?
Yes, the current price here for Skechers was $33.36. 52-week high here, $50.81, and the low, $31.28, down about 23.1% so far this year. I don't believe that's as bad as Nike. I think Nike's been hit a little bit harder.
Yeah, Nike's
here.
down over 50%.
Yeah, and I'm assuming they're having inventory problems as well at Skechers. Maybe just not as bad as Nike. But if I go forward to December 2023, I see estimated earnings per share here of $3.08. So if we use our 16.6 multiple on that $3.08, we would get a target sell price of $51.13. I mean, that looks very attractive. I mean, the valuations on Skechers are great. I would just want to know, who are they selling to? Because they're not selling to me, they're not selling to you, and they're not selling to Jeff either. So who's buying the Skechers? Because the numbers look good, the balance sheet's strong, even the growth going forward looks good. I mean, sales based off these analysts looks to be growing about 9-10% over the next few years, and earnings look even stronger, growing 36% next year. I mean, it's kind of a depressed number, but the earnings and sales growth look very good going forward.
Are they sold in stores? They have their own
I don't
stores?
know.
I don't even know how to buy a pair of Skechers. Do you know, Jeff?
I think they might have their own stores, like in shopping malls.
Okay. Well, I'm going to give you some research to do. You want to go to the mall today and buy a pair of Skechers and see how they feel. Because I like the numbers. I do see, I think they're mixed in with a lot of apparel. That 9 days ago, the estimate on earnings was $363, so they are coming down. But they've got a good balance sheet. They've got good profits. They've got good growth rates. They've got a lot of good things here. This could be a good business, and you have to hold it for probably, again, 2-3 years, what we like to hold things for. And again, you're not paying much for it. What was the price you said? 30-something, Chase? It was 33, 36. I think it's a pretty good price for it. And then if it goes to just like 45, I mean, you make a 50% return on that.
Yeah, so. I got distracted. I'm on their website just looking at shoes right now, just seeing what they got. They got some stuff that looks pretty cool.
Okay, so Jeff, call in next week. Next week, you're going to be wearing Skechers. Chase and I will go out and buy a pair. We'll all be wearing Skechers and see what we think.
and the price will go up, right?
Yeah, there we go.
All right. Thanks for taking my call.
Okay, Jeff, thanks for calling. Have a good one. Bye-bye. We kind of joke about Chase, but it is true. I mean, you want to understand the product. You want to try some of your own personal research. And we had a client that he's unhappy with one company we have because the service he got was bad. It's a huge company. And I said, that's going to happen. You got 4,000 locations across the country. You could went to a store that had a bad manager and so forth. But you still want to understand the product. And I joke about the shoe, but I know we had a client that I looked at buying Skechers before, and she loved them. Yeah. I love my Skechers.
I see you can take up to 40% off select sales right now.
That's probably why the earnings are down. But
yeah, I think they have the inventory issue as well. But I mean, I don't know. I would get a pair of these. I don't know how they are. Are they workout shoes? Are they wear around shoes? I mean, I don't know. I mean, I just know I've always been a Nike guy when it comes to football, and then that kind of affinity for Nike after playing for so many years carried over into just kind of the walk around gear and stuff. Right. But I don't know. And flip-flops. They don't make flip-flops, I don't think.
And wasn't there some big sports guy that's promoting Skechers that they actually had some special shoe thing, something?
I think, Joe Montana
was, yes. Yeah. He's a big Skechers guy, Joe Montana.
Yeah.
Well, he advertised it. But I think it is important. And I've looked at this company over the years, and they've always had good financials.
Yeah.
But they've not been on sale. I mean, now from a high of 50 down to 33, I think it'd be worth looking at this company because we like to hold companies that build stuff, and they build their own shoes. You look on the website; does it say anything if they're sold in stores or their own? Locations?
No. It looks like I can obviously just buy them online, but I mean they do have slip-ons, boots. They do have sandals, athletic sneakers, casual sneakers, boat shoes. I mean the boat shoes actually look pretty cool too. Really? The casual sneakers look pretty cool. I don't know. I mean I might be walking away here with a 40% off shoe because I need a new shoe anyways.
Well, you might do one. And I hate shopping. I think you hate shopping as well.
I hate it.
Yeah, but
it's just easy. I'm on the website right now. Maybe I'll just buy them.
But I don't like to buy stuff online because you get it like, that's the wrong size. Got to send it back. I like to go ahead and try them on and so forth. So maybe maybe I'll find some time to do that. But let's talk about the workshop, because, again, we talk about, you hear the radio show, you hear the numbers we go over. Well, the workshop, again, we've not done in 5 months. This will be, obviously, the last one for the year. It's going to be Thursday, November 17th at 6 o'clock. Seating is limited. It's going to be in Scripps Ranch. But it's a great place to learn about the fundamentals of investing and the strategies we use to find good value investments, how to invest during volatile markets. Wow, we got that for sure. So you want to know how to invest during these crazy times, and investing to build wealth and get you to retirement. This is all the things we talk about, and we take your questions. We get to talk to people afterwards as well. But what you have to do, you have to sign up. Again, it's Thursday, November 17th, 6 o'clock in Scripps Ranch. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And we do have a great time doing that as well, doing the workshop and talking with people. So like to see you there. But remember, seating is limited.
Yeah, no, I'm excited about that. And I was going to say, last comment on schedules before I move on, but, don't take fashion advice from me either. So I said they look pretty cool. I don't know what I'm talking about. So
you're not a fashion mogul, I guess, as they call it.
Fashionista, I think it's called.
Fashionista. Yeah. You're not. What's his name? Yeah, not Yanni. Who's the rapper that did a lot with fashion? Actually, you got
Kanye.
Kanye. I guess now he's called Ye. Where actually, I guess he lost some big contracts from Gap and somebody else. Adidas. Yeah, I don't know what's going on there, but he was kind of fashionista, I guess as you call it. Yeah. And now he's not. But you know what you like. You're the type of guy that I like it. I don't care if I'm gonna impress everybody, but it feels good. I'm gonna wear it and enjoy it. You are making a fashion statement, though. I'm gonna put this out there. If people notice and I watch you on TV, you're the only guy around that wears just a vest, no jacket. The vest. I
have noticed Attorney King.
What?
On his billboard, she's got just a vest, and I'm like, oh man. Hopefully he didn't beat me to it. No.
I don't think so, because he always used to wear a jacket. So maybe he saw.
Look at his billboards.
Yeah. I will look at his billboards, but yeah. So it's kind of your thing as opposed to wearing the jacket. So yeah. One thing I did want to talk about. We got a few minutes here. Was the big move on actually two companies. I don't know what I want to talk about.
I think
Apple.
Let's pick Apple.
I want to do Facebook, but
I'll do it because we have more data next week on Meta. So I think let's do that next week.
Okay, so let's talk about Apple a little bit. I got to pull it up, but that they did do the only tech company. Well, Netflix did well, but out of Amazon and Google and Microsoft, Apple's the only one that really turned around and went up. And it was, when we listened to it, why?
Yeah, I mean, they did beat on earnings. They beat on sales. They didn't really give real guidance for the end of the year. They're saying it was better than anticipated, but it wasn't really real guidance, so it's kind of strange. And the thing that concerns me, and we've talked about this, I'm just going to give people the numbers. You can make your own opinion from it, I guess, is the forward earnings multiple is still 23 times earnings. This year, you're looking for 2% earnings growth. Next year, 8% earnings growth, and sales is even worse. This year, 3% sales growth, and next year, 5% sales. You're not getting much growth. Right. And the big thing that people would always talk about is, their services. You don't get it because their services are growing at 20% a year. Their service revenue, 4.9% year-over-year growth. Yep. I don't know where that next catalyst for growth is going to come from to push Apple higher. And people, it's funny, they get all excited about the stock buybacks for Apple. They bought back, I think, $25 billion worth. Well, yeah, but it's a multi-trillion-dollar company now.
Right, that's what, $2 trillion. Yeah. So $25 billion is not that much. And the other thing, too, when you said the forward PE is, 23? Well, the current PE is 25.5. One thing you normally see is a big difference from that. That's not a big difference. Again, talking more about that growth, you're not getting a great deal here. Normally, if the PE is 25, you'd like to see that forward PE, 18, 19, to get some good deals going forward. It's just not there. And I think what maybe happened, all those big tech investors were very disappointed in Amazon, Google, Microsoft. Let's buy Apple because they didn't do as bad. That's all I can think of, because why this stock went up. And again, it's a great company, great product, but you are not paying up. You are paying up for the growth, and you're way overpaying for that growth.
And we'll see how holiday sales go with iPhone 14. I've said it before. Maybe iPhone 14 is okay.
Are you going to buy an iPhone 14?
No, absolutely not.
Your 7's still going to be good?
I got the 8.
Oh, the 8. Oh, you moved up.
I got the 8. I may get the SE if this thing craps out here, but not the 14.
How's it do? I mean, the 8. So that's how old now? 5 years old?
No, I think I've had this thing since I first moved home, so it's got to be at least 8 years. 7, 8 years, yeah.
7, 8 years. And still working. That's the important part. All right. Well, this is a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website, smartinvesting2000.com. That's smartinvesting2000.com. We got that workshop coming up November 17th, so sign up for that. And for more information, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Thanks for listening to the Smart Investing Show. We're back next week. Have a great day.
To think that I did all that, and may I say